This is the velocity problem. Revenue growth looks healthy, but the future value of your business is already declining. Hi, I'm Allison, and if you're new here, my company works with private manufacturers, distributors, and PE-backed executive teams on customer equity and value creation. Now it's January, and maybe you've wrapped up your fiscal year. Revenue grew, your board is happy, everything seems fine. But what if healthy revenue growth and eroding future value can happen at the exact same time? What if your business is winning today, but quietly losing tomorrow? Revenue growth is like speed. It tells how fast you're going, but not where you're going. If you remember physics, speed is scalar. It's just a number, 50 miles per hour, for example. But velocity is a vector, and it has magnitude and direction. So 50 miles per hour north. When you measure revenue growth, you're measuring speed, and you see that number go up. But you don't necessarily see who's driving that growth, why they're buying, or whether they'll still be there next year. Velocity, on the other hand, tells you where you're going to land. Speed tells you that you're moving. Today, I'll show you why revenue growth can mask dangerous erosion in your customer equity and how to spot it before it becomes a crisis. Because the companies that understand velocity, they don't just grow, they compound. Now, imagine you're the CEO of a regional distributor for industrial supplies or promotional items or even electrical components. Let's say your revenue went from 50 million to 60 million last year, 20% growth. And of course, your PE partners are nodding approvingly. But let me show you what might be happening underneath. Think of your business as a bucket. So revenue is the water flowing in from the top, and the traditional metrics just measure the water level. Is it higher than last year? Great. But what if there's a crack in that bucket and the water is leaking out faster than you realize and you're only staying ahead because you're pouring more in at the top? Well, that's eroding customer equity. And I see this pattern constantly. A company grows revenue by 20%, but customer equity, which is the future predictive value of their customer base, is actually negative 5%. How can that be? Well, maybe they acquired a bunch of new customers through aggressive promotions and price cuts. Revenue went up, but those new customers are one-time buyers with low repeat rates. They carry high acquisition costs, but they're not building equity. Meanwhile, the best customers, the ones spending $200,000 a year reliably, start to drift. Order frequency drops from monthly to quarterly, and a few high-dollar accounts perhaps churn quietly, no dramatic exit, they just stop calling. So revenue grows, but the company trades durable, high equity customers for transactional, low equity customers. And here's the dangerous part. By the time this shows up in your revenue numbers, it's too late. Revenue is a lagging indicator. It tells you what already happened. But customer equity is a leading indicator. It tells you what's about to happen. So the question isn't whether your revenue is growing. It's what kind of customers are driving that growth. Are they building your future or just inflating your present? Now let's talk about Domino's Pizza. I know you're thinking, well, hey, I run a B2B manufacturing company, and what does pizza have to do with me? Everything. In 2008, Domino's was in trouble. Revenue was declining, customer satisfaction was abysmal, and viral videos were actually mocking how bad their pizza tasted. Then Patrick Doyle became CEO, and he did something radical. He stopped focusing on revenue speed and he started focusing on customer velocity. He didn't ask, how do we sell more pizza? He asked, how do we build customers who will love us, stay with us, and spend more with us over time? They reformulated the entire product. They launched the pizza turnaround campaign where they literally apologized to customers. They invested years and millions in the pizza tracker without any immediate revenue impact, but massive effects on customer loyalty later on. This company was not chasing quarterly bumps. They were building customer equity. From 2010 to 2020, Domino's stock returned over 2,000%. They outperformed Google, Amazon, and Apple. That's right, a pizza company beat the tech giants, not because they had better technology, but because they knew where they were going, and they built a business that compounded customer value. Now contrast that with a B2B company who perhaps grew revenue 15% in 1 year. Pretty good. But when you analyze the data, they've actually grown by aggressively discounting. So therefore, revenue goes up, but those accounts had terrible margins and low repeat rates and high service costs. Meanwhile, 45 of that company's reliable customers reduced their spending by a third because the service levels dropped while the sales team was off chasing new logos. So revenue records as up 15%, but customer equity is down -8%. 2 years later, most of those discounted customers are gone. And so that's an example of speed without velocity. Now let's get tactical for a moment. How does customer equity erode while revenue grows? I see 3 common patterns that I'll call the 3 E's of erosion. The first E is exodus. Your best customers are quietly leaving, but new acquisition masks the decline. Your top 50 customers, for example, might represent 80% of your revenue, but 10 of them start drifting. Their orders drop from 50,000 a quarter to 35K. That's 600,000 that you've lost annually, but you acquire 30 customers who are new who spend 800,000. Net revenue is up 200,000 and your dashboard is green, but those drifting customers were high equity, loyal, predictable, expanding, and the new customers are transactional with a high churn risk. You've traded equity for activity. So the second E is the expensive win. You grow by attracting low margin, high maintenance customers who look good on the top line, but actually destroy value on the bottom. A company happens to win a big contract. Revenue jumps 20%, but that customer demands net 60 terms, custom packaging, expedited shipping. So the gross margin on the business is 8%, much lower than the typical 22% of this business. Then that customer churns after 18 months when a competitor happens to undercut them by half a point. You grew revenue, but you didn't actually grow value. The third E is efficiency drain. A significant portion of your customers are dead or dying, but they're still generating some revenue. So you keep them on life support, draining attention from customers who actually matter. I worked with a manufacturer who had 1,200 customers and 1/3 of them, or 400, had negative predictive lifetime value. They were costing more to serve than they would ever generate. But because they placed the occasional order, they still got sales calls and marketing email and high customer service levels. Meanwhile, the top 200 rising customers representing 80% of future value got the same level of attention as those bottom 400. All 3 patterns share the same cause: measuring speed, not velocity. And this doesn't just hurt your P&L, it directly erodes the enterprise value. When a buyer evaluates your business, they're looking at customer concentration, retention rates, repeat purchase behavior, margin quality. Basically, they're reverse engineering your customer equity, even if they don't call it that. Let's talk about how to measure velocity. Customer equity is not ABC analysis or RFM scoring, those are backward looking. They tell you what your customers did. Customer equity is a predictive model that calculates the future value of each individual customer based on their behavior and trajectory and context. Which customers are likely to expand, which are at risk, which are actually worth investing in, and which should be managed for efficiency. When you aggregate individual customer equity across your entire base, you get total customer equity, the predicted future value of your business. That number is your velocity. Companies that use customer equity as a strategic compass make different decisions. They stop chasing every deal and prioritize high equity accounts. They concentrate investment where it compounds, and they stop celebrating revenue growth and start celebrating equity growth. Revenue is what you earned yesterday. Customer equity is what you'll earn tomorrow. If you're only measuring one, then you're flying blind. And this is why I say customer equity is where enterprise value begins. Every dollar of enterprise value starts with a customer who chose you, stayed with you, and will choose you again tomorrow. Now, if you're a CEO, ask yourself, do I know whether my revenue growth is building or eroding my customer equity? Can I identify which customers are driving growth and perhaps whether they're high equity or low equity? Are my best customers getting stronger or quietly drifting? On the other hand, if you're a CFO, when you allocate capital, are you optimizing for short-term revenue or long-term customer value? Every dollar you spend is either building equity or it's not. There's really no neutral. If you're in sales leadership, is your team focused on customer quality or just customer quantity? If your comp plan rewards revenue without regard to customer equity, you're going to get exactly what you're measuring. Now, this is fixable. It starts with visibility. That is, seeing your customer base through an equity lens, knowing which customers are assets and which ones are perhaps future liabilities. When you make that shift, your revenue growth becomes durable and not just a spike from a promotion, but compounding growth from customers who love you and want to get more valuable over time. They want to do more business with you. Your margins improve because you're not chasing low margin customers just to hit a target. Your enterprise value actually starts to increase because those buyers don't just look at revenue, they look at customer quality. A business with, say, $50 million in revenue and high customer equity commands a significantly higher multiple than one with $50 million and an eroding or dying customer base. Remember Domino's, a pizza company that built the tech companies because they measured velocity, not just speed. You can do the same thing. If you have customers who give you money for value, you have customer equity. And if you measure it, you can grow it. Stop celebrating blind revenue growth and start interrogating it. Ask where it's coming from. Ask whether it's building your future or just inflating your present. Measure velocity, not just speed, because the companies that do, they don't just grow, they win. And if you want to explore what customer equity analysis could reveal in your business, DM me on this channel or visit customerequity.ai. Thanks for watching.